income space for last week and what we can expect this week. Very quickly, we'll be looking at the money market and treasury bills market. Interesting times as we see the open repo rate and overnight rates concluded the week at 28.90% and 29.15% respectively. Although system liquidity showed improvement basis, it still ended the week in a negative territory due to significant settlement obligations that rose during the week. This indicates that despite the liquidity gains, the system's overall cash position remained under pressure from outgoing funds. For the Treasury bill secondary market, it ended the week on a downbeat note, with yields adjusting upwards in response to the primary market auction results and ongoing liquidity constraints. As a result, average yields rose by 40 basis points, settling at 18.36%. This increase reflects the market's reaction to the auction outcomes and prevailing liquidity pressures, which continued to weigh on market sentiments. In the most recent Nigerian Treasury bills auction, we can observe from the table displayed, the Central Bank of Nigeria offered 230 billion worth of NTBs, which attracted strong demand, resulting in an oversubscription of 166.42 billion. Consequently, CBN allotted a total of 303.79 billion, exceeding the initial offer amount. The auction results showing various spec rates movements across different tenors. The 91-day bills saw 35 basis points increase. The 181-day bills maintained unchanged, and the 364-day bill experienced a significant 94 basis points hike. Taking a quick look at the bond market, the FGN bond market, secondary market, ended the week on a negative note, with selling pressures dominating market activity and overshadowing buying interest. As a result, bond prices declined and yields have increased, reflecting the bearish sentiment. The imbalance between supply and demand led to a market environment where sellers outweighed buyers, influencing the overall market tone. Analyzing the yield curve on a tenor basis, we observed certain distinct movements. The short end of the curve saw yields decrease by an average of 6 basis points, indicating increased demands or improved sentiments for shorter-term instruments. In contrast, the mid to long end curve experienced yield increase of 22 basis points, suggesting selling pressures or decreased appetite for long-term bonds. The divergence in yield movements across the curve may reflect market expectation and sentiments regarding future interest rate trends and economic conditions. Trading activities over the week concentrated in specific bond maturities, with the 2026, the 2029, the 2031, the 2033, the 2034, and the 2038 bonds being amongst the most actively traded for the week. These maturities attracted investors' interest due to their liquidity, their yield profiles, or aligned with market expectations. The focus on these tenors may indicate investors' preference for specific segments of the yield curve, potentially driven by market outlook, risk appetite, or investor strategy. Across the benchmark bonds, yields saw a general increase, rising by an average of 8 basis points over the week. By the week's close, the average yield has settled at 16.70%. This upward shift in yields suggests a slight decrease in bond prices, potentially driven by changes in market sentiment and investor demands. The 8 basis points increase indicates a moderate adjustment in bond markets, reflecting evolving investor expectations and market dynamics. For the foreign exchange market, the Naira witnessed a depreciation in value, as we saw a negative 0.30 change on the NAFEM window, closing the week at 1,538 Naira 0.08 kobo, as compared to 1,530 Naira 42 kobo the previous week. And for the forwards, we see rates continue on a steady increase from the 1 month to 1 year forward. Outlook for the week. This week, absent of any substantial liquidity injection or significant inflow, funding rates are likely to persist at current levels, likely due to anticipated outflow from the federal government of Nigeria bond settlement. The impending settlement obligation continue to exert pressure on liquidity, thereby supporting the current funding rates. Unless there is notable influx of funds, the market can expect the existing rate environments to prevail, influenced by the bond settlement's impact on liquidity dynamics. Trading activities in the Treasury bills market is anticipated to be largely influenced by prevailing system liquidity conditions. As liquidity levels fluctuate, Market participants are likely to adjust their buying and selling strategies accordingly, impacting prices and yields. Depending on whether the system experiences surplus or deficit liquidity, the market may see shifts in demand and supply, dynamics and shaping overall market sentiments. And lastly, trading activities in the bond market is expected to be subdued and relatively quiet as market participants await the outcome of this week's primary market auction. Investors may adopt a cautious stance, holding off and making significant trades until the auction results are announced, which could influence market sentiments and direction. As a result, the secondary market may experience lower trading volumes and narrower price movements, with participants waiting for clarity on bond pricing and demand from primary auction. That being said, we implore you lead investors to take advantage of the market by taking position now. This can be achieved by subscribing to a wide array of products ranging from our lead fixed income fund, which prioritizes capital preservation and growth, offering a low-risk investment option with biannual dividend payments. However, it is essential to note that the fund comes with a 90-day lockdown period during which investors cannot access their funds. It is worthy to note that currently yields on the fund stands at an 18.56%. We encourage investors to take advantage of this. For investors seeking a balanced portfolio, we recommend the Lead Balance Fund. This fund diversifies investment 50% on high-quality stocks and 50% in fixed income instruments, offering a medium risk profile. With a mix of equities and fixed income instruments, helps investors to spread their risks. It is suitable for investors willing to take on moderate risk for potential returns. Investors who cannot invest or collect their annual Investors can also choose to invest or collect their annual paid dividends. With a lockdown period of 90 days, it allows relatively easy annual paid dividends. It allows relatively easy entry and exit from the fund. The Lead Balance Fund is currently an annualized yield of 43.45%. We encourage our lead investors to also take advantage of this fund. For investors looking to invest for a fixed period at a predetermined date, we recommend the Lead Gazelle portfolio. The portfolio offers tenors ranging from 90 to 365 days, providing competitive rates that surpass standard commercial bank rates. We encourage investors to reach out to us to enable us share the current rates if you're interested in this platform. For investors seeking to protect their assets from depreciating naira, we recommend our Eurobond trading platform. This platform allows clients to invest directly in US dollar denominated debt instruments, earning returns in the same currency through biannual bond payments. Please note the minimum subscription to this platform is $200,000. For investors who cannot meet up to the $200,000 threshold, we introduce our Lead Dollar Fund. This product offers a viable alternative with a minimum subscription of $1,000 and holding period of 180 days. Dividends are being paid biannually and a low risk profile at 9.23% annualized yield. That's it from us on the fixed income space. Allow me to hand you over to our in-house equities analyst, Mr. Taufik Akolade, to give you insights on the happenings in the equities environment for last week and what we can expect.
Thank you, Mr. Kemi. Thank you for taking us through the happenings in the fixed income market. Lead investors, good morning, everyone. So you are welcome to another edition of Equities Market Review. In line with our expectation, market also witnessed another negative sentiment. If you look at our projections and our expectations for the week, we had already predicted that most of the takers have actually reached their 52-week high, so which was the reason market witnessed some correction. So we will still maintain these key headlines. We are going to take a review. We're also going to make provisions for a lead top pick for the week because our recommendation has 3 layers. So you have the buy, hold, and then the sell. We have also expanded our coverage to about almost 12 sectors for those who also want to diversify their portfolio, so that you can have an opportunity to diversify your portfolio across various sectors other than the key major sectors: the banking, insurance, consumer, oil and gas, and the industrial. So we've also included aviation, real estate, construction, healthcare, and a few others. So private investors, you have the opportunity to select from arrays of the sectors we have also included in our recommendation. So we will be talking about the review of the equities market last week. So for the entire 5 trading days, the sentiment persisted for the first 3 out of the 5 trading days. So it was only on Friday and at the beginning of the week, market witnessed some uptick in the prices of the selected stock. But the reasons why we saw that depreciation in the market last week was because some of the highly capitalized stocks, the likes of Bois Cement lost almost 10%. Even Dangote Cement, under industrial segment of the market, also lost 9.9%. Stanbic IBTC people taking profits. We also saw a few other companies like a GTB, Stanbic Bank, even Zenith Bank, and a few other middle capitalized stocks. If you look at this graph, and you could see that from Monday, the graph was on a downward slope because people are taking profit. So, but the most important thing is that the investors should not be wary of what is happening in the market. There's no need for you to be panicked because it's expected that investors is an opportunity for them to also witness what is happening in the market. Why those who have invested in the market for a very long time, they have faced issues like this, times like this, that the market will continue to witness correction, especially when it's getting to 2 weeks high, and that's exactly what is happening. So when tickers or some companies get to the overbought region, then you are likely see profit taking. So, and that's exactly what happened. There's no cause for alarm. There's still liquidity within the market. The key catalysts, the key drivers of the market, they are still positive. We see inflation figure for the month of July is still moderated. We've seen the GDP. But we need to consider what is happening within our local economy, at least the global economy. That's also going to determine whether we'll continue to advise our customers whether they should invest in the equities market or the fixed income market. But the truth is that it are still very strong and there's still room for growth. There is room for the prices to still grow because those stability in volume exchange markets also yes, it was what contribute to the processes that are listed in our market. So like we saw uh, quantity traded still centered around financial service, almost 78%, because we saw major activities around insurance company and then the banking. While we saw minimum transaction, a minimum volume trading around a consumer service industry and others. So that's why the financial services dominated the larger part of the start. And then also the fact the financial services very soon in our we are seeing more insurance. These are the reasons why the pie chart is also expanding anytime we are making this presentation. So in terms of a week to date, last week markets also lost 2.51%. We now saw depreciation in ASI to 141,000, and then we also noticed that the volume also reduced, while the value also increased. The volume reduced to 4.7 billion from 85.65 billion. But in terms of the value increased to 107.43 billion. So that's still mentioning that the key drivers, the activity, the daily trading volume and weekly volume are still very strong. So that is to tell us that the market correction we have seen in the market is just temporary. We are likely to see no investors in the market, and those who have also rebalanced their portfolio are also responsible. We have seen in the market. Actually, we saw Universal Insurance, Zenith Bank, and FCMB. They accounted for like almost 25.16% in terms of the volume for the entire transaction, and in terms of the value, that's a week trillion. The good things that anytime there's a correction from the market, for those who have been waiting of a particular stock price, once there's a depreciation or there's a correction in the market, that will also present new opportunity because the persistent or continued depreciation in the market is just temporary. It's not really a setback, but just a correction. So if we check the major indices last week, it was only one index that actually appreciated, that's NGX Consumer. It was also marginal. While the banking, insurance, industrial, oil and gas, they lost 3.48%. That's for the NGX banking, and then insurance industrial, white oil and gas, taking our cement and then these are various points that this depreciation in the sectoral indices is unavoidable to invest that the market is really very good. Correction that's a beautiful companies portfolio.